Good afternoon, ladies and gentlemen, and welcome. I'm Chris Andrews, Chief Investment Officer here at Latrobe Financial, and we are very pleased to again welcome a very large number, a growing number of people from across Australia for our quarterly investor call briefing covering the second quarter of the 2016 financial year. Now, as always, these sessions are designed to encourage questions. You should be able to see on screen where you can type yours. I'll answer as many as I can at the end of this session on a first-come, first-served basis. Now, with the sheer numbers attending today, I may not be able to get to all of you. I'll finish this session promptly at 12:30, but I'll do the best I can and follow up individually with anyone that I have missed. I should also point out that in these sessions, I'll not be commenting on individual portfolios or assets. This isn't the time or the place. As always, our investor sales team is ready to assist you on these matters on our free call national number, 1-800-818-818. As a final point of administration, I welcome our FBAA members who are attending today, and for those who are seeking the 0.5 CPD points for today's briefing, please email us at marketing@latrobefinancial.com.au and we'll send the CPD confirmation code to you today. So, on that note, let's begin. Today's investor call will provide you with our current view of the key issues driving investment opportunities for you. First, we'll look at the macroeconomic landscape, both domestic and global. Secondly, we will update you on the Australian property market. Where is it now and where is it headed? And thirdly, we'll provide an update, as we always do on Latrobe Financial, and conclude with the quarterly performance of our billion-dollar Latrobe Australian Credit Fund investment options. So let's start with our headwinds and tailwinds report, our macro view of the global and domestic economy. And first to the headwinds. Last quarter we discussed China's moderating growth, and it's fair to say that the world remains obsessed with China. In fact, if the Australian economy used to catch a cold when the US sneezed, it now looks like the whole world becomes bedridden when China gets the snuffles. Now, one pointer to sentiment is the Chinese stock market. Since the start of 2016, the benchmark Shanghai Composite Index has dropped dramatically, continuing the sell-off that really began in mid-2015 when Chinese investors clearly decided that the extraordinary bull market run had wildly overshot fair value. Now, international investors have taken their cues from this and sentiment has turned negative, probably excessively negative in our view. Nouriel Roubini put it well at Davos in late January when he said that markets had swung from fawning adulation around China to near revulsion on scant knowledge and a string of misunderstandings. The reality is that Chinese growth is slowing, but not by enough to justify the hysteria. In fact, there's some evidence from indicators like car sales, up every month from July to December last year and still strong in January, that the real Chinese economy might in fact be picking up some steam again. But while markets remain so bipolar, the prophecies can become self-fulfilling. So China fears are a headwind for our investor. And that takes us to our second headwind. For almost a decade, commentators and economists have been debating the likely long-term effects of the extraordinary, unprecedented central bank QE or quantitative easing program. Some, including the treasurer of our future fund, including the chairman of our future fund, former Treasurer Peter Costello, argue that this program has artificially inflated asset prices into bubble territory, everything from financial assets to commodities. With the first concrete signs now coming that the US Federal Reserve, or the Fed, is withdrawing from QE, there is a real risk either of a price correction or a prolonged period of asset deflation and lower returns for investors. Interestingly, when you look at the Future Fund, Australia's largest investor, you can see an asset allocation premised on this risk. Cash holdings are at an extraordinary 20% and just 6.5% of funds under management are in Australian shares. So that's another headwind for Australian investors. Turning to the third headwind, share market commentators frequently console investors experiencing portfolio losses with the assertion that, in the long run, stock markets bounce back from slumps. Now, the trouble with this, of course, is, as John Maynard Keynes famously said, in the long run, we're all dead. It's true that stock markets tend to bounce back, but there is no law that this must occur in the useful lifetime of an investor. In fact, as the graph on screen of the S&P ASX 200 shows, Australian investors are now perilously close to a full decade of zero capital growth. Now, sure, there have been dividends paid as well, but dividends alone don't compensate equity investors for the volatility and the risk of capital loss that they take on by investing in the share market. And if you're tempted to think that this extended stagnation means that a boom is around the corner, remember the views of global investors like the Future Fund, as we've just discussed. They're preparing for the opposite. Remember too that generational stagnation in share values is entirely possible. It took the US 2.5 decades to regain its losses after the Great Depression, and the Japanese Nikkei is still less than half of its December 1989 value, despite an Abenomics-led surge, the so-called three arrows policy of easing monetary policy, expansionary fiscal policy, and structural reforms that were adopted by the Japanese government and have been implemented since 2012. The bottom line is, as this very interesting chart on screen from Dr. Doug Turek of the Eureka Report shows, unlike the US, Australia has been experiencing a corporate earnings recession since the GFC. The share market is below pre-GFC levels because corporate profits are below GFC levels. In the US, profits are 30% higher than they were, and that's a stark contrast. Now, we're well into reporting season now. Bloomberg expectations at the start were for earnings per shares declines of around 4.45% for the S&P ASX 200. As at the end of last week, it looked like we might do a little worse than that, with consensus estimates predicting an 8.9% decrease in earnings per share. From the point of view of fundamentals, it would be hard to expect a significant uptick in share values whilst earnings are declining. Now, shares continue to be an important market, which with all serious investors should be engaged. But there are also risks, and it's important that investors understand them. In our view, investors should build portfolios that include significant exposures to non-equity based assets like fixed interest. So that's the headwinds. Let's turn now to the tailwinds, those positive signs for the economy and/or for investors. And anyone who's filled a car with petrol recently will have noticed the significant decrease in petrol prices. To read much of the commentary, one would think that this decrease is a disaster, and certainly it's not helpful for oil-producing nations and companies. There is also a substantial risk that this could have a flow-on effect into the banking system. Lenders who have significant exposures to these types of companies could incur losses. Until some certainty is achieved around the extent of these losses and exposures, financial markets are going to be volatile. But we shouldn't forget that oil is both an important item in household budgets and a critical factor of production. Lower oil prices are significantly stimulatory in both these sectors. Remember that recent decreases have been driven by fundamentals. Peak oil predictions of the mid-2000s were confounded by the rapid addition of non-conventional sources of energy, such as US shale oil. Supply has outpaced demand for a couple of years. So Australian consumers have seen petrol prices drop by 60% on average over the last 2 years, and based on ABS figures for household spending, this results in more than $1,000 being added to household finances. Now that's enormously stimulatory. It helps the retail sector, helps the travel and tourism sector, and so on. It also helps the big energy consumers, airlines. Anyone seen Qantas's recent results? Really positive. Miners, petrochemicals. It helps the two big energy importers. China and South Korea are two key trading partners who leap to mind. So provided portfolios are not overexposed to oil-producing companies or financiers with exposures to these, the oil price decrease could be a material positive. There should be little need for us to expand on the second tailwind. We've been discussing it now for some time. The economy in general is benefited by record low interest rates. The additional funding in borrowers' pockets can be spent in shops, restaurants, used to pay down debt, or whatever. Of course, the losers from low interest rates are savers, generally retirees who are relying on one form of interest-paying investment or another for their living expenses. Funds sitting in bank deposits are simply not generating adequate returns. Speaking of interest rates, we often get a lot of questions about the prediction we made 18 months ago that rates would remain around current levels for up to the next decade. So for complete transparency, the progress to date is on screen. Our specific prediction was that the official cash rate would remain within 50 basis points of the level prevailing at the time, which was 2.5% per annum. We're still in the money and between the lines on that prediction. Time will obviously tell whether we got that call right. Should current market volatility result in sustained global downturns, or should the Australian dollar move upwards dramatically, we will see further pressure on the RBA for yet another drop. At this stage though, we're with the market, which through the ASX 300-day interbank cash rate futures is predicting with 94% probability that rates will remain at current levels in March. Now we'll keep you posted on this one in future investor call briefings. The third tailwind is unemployment, which has continued to defy analyst predictions with a steady trend decline over the last 6 months of 2015. Now, January did see an increase to 6%. There's been some noise around these figures and their reliability for some time. We've commented on this in previous briefings, but the persistence of a solid unemployment trend is undeniable. We'll be continuing to watch this space and the stats here very closely, but for now we've booked this as a tailwind for the Australian economy and for investors generally. The final tailwind is the household sector, and it's sending a number of positive signals at the moment. Whether you look at residential building approvals, retail sales growth, whether you're looking at consumer sentiment or household wealth, you are seeing some of the strongest results since the GFC. Now, it should be noted that consumer sentiment did fall back in January on the back of market volatility, but it's rebounded strongly in February. Now, this is welcome news, and in our view, a continuation, or at least a sign of the continuation, of the rebalancing of the Australian economy. Overall, over the last quarter, we've grown more bearish on economic prospects. Credit markets are stressed, and there's a risk that price issues in the resources and energy sectors could work their way into the financial system. More volatility can be expected in the banking and financial markets until these issues are resolved, and the resources and energy sectors are going to experience some very difficult times. However, we remain fundamentally optimistic about the future and the opportunities presenting themselves to the Australian economy. So on that note, we now turn to the Australian property market. And we start with a very powerful chart from our friends at CoreLogic about residential real estate in Australia. Residential real estate dwarfs in value the share market, even the entire superannuation savings of the nation. It really has been the base on which the dreams of the Australian investor have been built. On a median level, outcomes have reflected what we predicted in our last investor call briefing in October. Nationally, price growth continues, but has moderated. Of course, on a city-by-city basis, we continue to see a very differentiated picture. Annual growth to 31 January varies substantially. Melbourne and Sydney experienced low double-digit growth, but the experience of the rest of Australia is very different indeed, with Perth and Darwin well into negative territory. And that leaves us with a picture, as always, of a very diverse Australian property market. The leading indicators of price growth, so what is pointing to what's going to happen into the future, indicators like auction clearance rates and stock listings, they continue to point to a moderation in housing price growth in the months ahead. This is buttressed by CoreLogic's proprietary mortgage index, a really interesting indicator. It draws on valuation volumes from most of Australia's mortgage market to gauge lender activity levels. It's also supported by fundamental demographic data. Population growth is slowing due to reduced overseas migration and slower natural population increase. Australians are having less babies. Growth in demand responds to this by reducing, resulting in more moderate price growth. So at a national level, we're expecting to see moderating price growth to continue. The Sydney and Melbourne markets remain strong, but are showing definite signs of this general slowdown in growth rates. There will be continued pressure in the more volatile Perth and Darwin markets, obviously reflecting challenges in the resources sector in particular. And that broadly is the property market summary for this quarter. So let's now turn to Latrobe Financial. And it's been a terrific quarter for the Latrobe Financial Group. I'm really pleased to report. All key indicators are really positive. Funds under management has grown strongly, both at a retail and a group level. In October, the fund passed the $1 billion mark, which is really strong and reflecting very strong and continuing investor support for our offering. Group revenue for the financial year to date has been very strong at 94.3 million, tracking to be substantially up on last year. And group equity now sits at $100 million. And this reflects the commitment of the organisation to the long term. We've been here for more than 60 years and we will continue for many, many more. And that takes us to the detail of our retail investment offerings, the Latrobe Australian Credit Fund. So let's dig into this in a little more detail. Remembering as usual that our fund is not a bank deposit, we always have to say this, it has different risk return characteristics, and we should also note, as we always do, that past performance is not a guarantee of future performance. So with those caveats, you can get a sense of the fund's profile by looking at some of the key indicators on screen. The cash and mortgages option is currently outperforming its benchmark by 1.2% per annum. It's got a weighted average LVR of 61.4%, so lots of strength and stability for investors there, and 90-day plus arrears of just 2.5%. So it presents a very strong profile for investors. Turning to the pool mortgages option, well, it also continues to present a stellar performance profile as what is probably the flagship of the fund. It's got well over $500 million in funds under management and is outperforming its benchmark by a really impressive 1.42% per annum, 142 points, with arrears of just 1% and 1,373 individual first mortgage secured loans. Again, a very powerful offering for investors. Maintains its independent ratings, of course, and in December, I'm really proud to announce it was awarded a historic 7th consecutive award for Best Mortgage Fund in Australia by our friends at Money Magazine, so something we're very proud of there. On an accumulation basis, looking at its performance, the PMO has continued to mix it with the best of the alternative asset classes, a performance that's been consistent since inception, way back in 2002. Given the volatility we're seeing across markets at the moment, this is something that is very highly attractive to investors. Really takes sort of the issue of timing the market off the table, and that's something we're really proud of achieving for our investor base. The Select Mortgages option, of course, is Australia's largest and most robust portfolio of peer-to-peer investments, and we've been getting a lot of questions about this recently. We've been managing these peer-to-peer investments for 20 years. We've got well over 5,000 investors investing on a peer-to-peer basis through our platform and achieving terrific results, as the portfolio summary on screen shows. Now, the shopping list on our website, if you haven't seen it, I'd encourage you to take a look. It offers outstanding peer-to-peer functionality, and we'll have more enhancements coming in the months ahead. So very much watch this space on the peer-to-peer offerings. For the more experienced investors, our high yield peer-to-peer option is attracting a lot of attention. We currently have 30.3 million at the end of December in funds under management in the high yield option, predominantly in mezzanine or second mortgage type loans. In the coming months, we're looking to introduce other credit-based investments into the option, including RMBS and CMBS investments. So more in that in coming briefings. Interested investors can in fact register their interest in these other credit offerings through the high yield option with our investment team on 1-800-818-818. So that's the nutshell summary of the fund. We'll now turn to our Q&A section, and turning to the technology there, can see our first question is from Michelle. And Michelle's saying, I'm again reading about predictions of a massive fall in property prices. What is your take on this? Well, thanks, Michelle. I'm trying to remember exactly how that famous saying goes about economists predicting 10 of the last 3 recessions, something like that. Anyway, look, for the last decade or so, we've been hearing predictions that a property price correction is coming to Australia and coming soon. You'll recall, must have been back in 2008, 2009, that economist Stephen Keen took a bet with Rory Robertson, who's I think now at Westpac, and Stephen was predicting a 40% correction in property prices during the GFC. A couple of years after that, we had US investment guru Jeremy Grantham calling for a 40% overvaluation in Australian property market that was soon to crash. Obviously, he was taking a short position against the banks. I guess we could multiply the list of these doomsayers on and on. Now, our view is that obviously, and to us this is very obvious, there is no immutable law that property prices always have to go up. From time to time, they will correct just like every other market, every other sector. The real question is whether there are real signs at the moment that the property market, or that the housing market in particular, is in distress. Now, in recent days, we've had economist Jonathan Tepper, hedge fund manager John Hempton, both promoting their views. They've taken short positions against Australian banks. And as I understand from their commentary, they toured Western Sydney for a week and concluded that there's an oversupply of apartments, that local prices are very high, particularly for things like apartments, and that lending practices are reminiscent of the US pre-GFC, with high LVRs, poor checks on serviceability and the like. Now, the problem I have with a position like this is most of it is demonstrably untrue. While there are always sections of any market, including the property market, that overheat for a variety of reasons, Australian LVRs are by and large very low and controlled. 90% and above LVRs across the Australian lending system are just 6% of loans. I mean, surely that's not a systemic issue. At Latrobe Financial, obviously, as you're probably all aware, the maximum that our fund lends to is just 75% of the value of the property. Defaults and arrears in Australia remain low. In fact, they're amongst the lowest in the world, and that's been a consistent theme of the Australian lending market for a very long time. And there's no, in Australia at least, there's no significant issue around honeymoon and teaser rates, which was some of the real problems in the US lending market pre-GFC. Borrowers would take out loans that would be at 2% for 2 years and then adjust to 12%. Those sorts of loans just aren't a significant part of the Australian lending picture. There are always exceptions, but broadly, Australian lending practices have remained strong and have continued to be tested and scrutinised closely by the RBA. Bottom line, whilst on some metrics, you'll see that housing prices in Australia look high, there are no current signs of any sort of dramatic correction in the near future, and you've got to take the long view. You've got to look at fundamental drivers of demand and supply. Population growth in the last 3 years in Western Sydney has been strong. The price of credit is cheap. With interest rates so low, as we've been discussing for a long time, borrowers can afford to extend themselves more broadly. And no one talks about the fact that lenders typically test serviceability with a 2% buffer. They factor in a 2% increase in interest rates. So, put the hype aside. Are there really strong signs of stress in the property sector? Not at all. We're continuing to expect, for the quarter ahead, this sort of moderating price growth that we've been talking about for the last really 3 to 6 months. So I hope that's a comprehensive enough answer for you, Michelle. Looking now, we've got a number of questions about peer-to-peer investments. So if I just pick out some of these, peer-to-peer. So we have a question from Jeff. What is peer-to-peer investment? No, good question, Jeff. Look, at its core, peer-to-peer investment is the concept of joining an individual investor to an individual borrower. So a really direct connection. An investor can choose the borrower they're investing in. Now, we see with some recent peer-to-peer branded entrants, they've developed models that they market as peer-to-peer, but they're actually pooled investment schemes of one type or another. Now, in our view, that's probably shouldn't be referred to as peer-to-peer. Probably, another term of jargon, I guess, that's making its way into the lexicon is marketplace lending, and perhaps that better suits these sorts of models. But for those investors and for advisors who are after genuine peer-to-peer investment, there is a vibrant and flourishing market available, and Latrobe Financial's, I guess, one of those participants. Kirsty is asking about Latrobe Financial's peer-to-peer investments, how they work. Okay, so Latrobe Financial's Select Mortgages options part of the Latrobe Australian Credit Fund. The Select Mortgages option lets investors invest in individual loans that they select themselves or through their advisors from our shopping list. We have a shopping list online. I'd encourage you to check it out on our website. All of these loans are secured by a registered first mortgage. We're not talking about unsecured personal lending here. Returns range from 5.5% to 8.5% depending on the type of loan. So you can look at sort of conservative vanilla residential type loans if that's your if that's the sort of exposure you'd like, or you could choose perhaps construction and development loans and achieve a higher yield that way. We've got around 300 loans, a real variety of loans, and 500 loans and around $300 million under management in our peer-to-peer portfolio. At any one time, we've got something like 50, 60, 70, 80 loans available for investment on our shopping list. We believe this is the largest, most robust peer-to-peer portfolio in Australia, and it's a really important part of our offering for investors. And again, on peer-to-peer, so it's a real peer-to-peer session today. We have Joe. How is, if I summarise, how is Latrobe's offering in the peer-to-peer sector different to others in the market? Okay. I've talked a little bit about this, but first, the first thing to note is that our advisors and investors get to select from a diverse range of mortgage secured loans across Australia. So they're mortgage loans and unsecured personal loans. All are subject to our normal rigorous credit assessment. Maximum LVR is 75%. So there's a real diversity within that framework that allows advisors and investors to choose their own risk profiles. That notion of choice and control is fundamental to the whole peer-to-peer scenario. The second thing I guess I'd point to is that our offering's built around a registered managed investment scheme. It's a time-tested structure. It's completely transparent. Investors get full disclosure in relation to their individual loans before they invest. So they can even review the independent valuation of the security property if that's of interest to them. And we report comprehensively on the whole portfolio each month. I suppose the final point I'd point to, the final issue I'd point to, I guess, is our experience in the sector. Unlike many peer-to-peer startups that we've seen appearing over the last sort of 3-4 years in Australia and previously, well, in the UK and the US, Latrobe Financial has over 60 years experience in the asset class, and we've got around 20 years in the peer-to-peer space. There's a famous saying about lending. It's always easy to lend money. The trick and the art of being a successful manager in this sector is getting it back. Now, at Latrobe Financial, we've seen the good times and the bad, and our processes are battle hardened, and that's really important. So our track record in this space has been peerless in our view. We'll be receiving an independent rating on our peer-to-peer offerings in the next sort of month or so, and so we're really looking forward. Watch this space and you'll see that. I can't say too much more on it at this point, but keep your eye out and you'll see an independent research paper being released shortly on our peer-to-peer offerings. So that's something we're very proud of. Now, looking where we are, look, I've still got a host of questions to get to, but given that time is running out, I will draw a line through there. So we'll follow up these questions individually, and I apologise that I couldn't get to them in this session. I would like to say to everyone, though, thank you for your attendance. It's really been wonderful, as always, having you along for our investor call briefing for the second quarter of the 2016 financial year. It's been a great quarter. We're really looking forward to continuing to deliver for our investors in the months ahead. We are very bullish about the performance we're able to achieve for investors and looking forward to continuing to deliver that in the months ahead. But for now, thank you for your attendance and support. Whatever markets you're in, we hope they continue to be profitable, and bye for now.